Hi, I'm Juliet Schooling Latter from Fund Caliber, and today I'm talking to Simon Adler, manager of Schroder Global Recovery. Simon, thank you for joining me.
Thank you.
Now, you're a value investor, and value has had a hard time for quite a number of years, but it's actually had a much better sort of 6 months or so. What's caused the reversal of fortunes, and is it likely to continue?
Yeah, I think it's probably, if we cover the first bit, what's caused the reversal of fortunes first, I think there's probably two things to point to there. The first is that when we got to last summer and early autumn last year, value had just got extremely cheap. As we know, the biggest determinator of future performance is the price you pay. And value had got to a place where it was exceptionally cheap. We went on record saying that we thought this was an extremely attractive opportunity to buy value. So the first reason it's had a reverse in fortunes is just that it got too cheap in the first place. But then there is a second reason, which is that was compounded by the Pfizer vaccine news at the beginning of November. Now, as you'll remember, that the kind of data came back with a far higher efficacy than people expected in terms of the impact of the vaccine. And that allowed the stock market to kind of move forward, to think about that we would reopen one day, to think about the fact that the world was going to get more open, more free, and to start moving on with the future. And Biden then got elected, and so we then had big infrastructure spends. We got monetary and fiscal stimulus at the same time as we could see an end to the COVID issues. So I think those two things, the fact that it got too cheap in the first place, and then that people started looking to the future and things reopening, interest rates maybe rising a bit, inflation maybe rising a bit, that allowed people to reassess value, I think, and value to have had that kind of reversal of fortunes that you said. In terms of whether it will continue, the kind of $1 million question, I think I'd point to two top-down issues and one bottom-up issue as to why we think it can continue. So from a top-down perspective, the first one is just the level of dispersion in the market today. So even after the recent bounce in value, the dispersion between value and growth remains at levels in line with the dot-com boom today. So, the dot-com boom, which was regarded as a kind of parody of markets, it got so ridiculous. Even after the recent bounce in value, we are still at those kind of levels. And it's probably worth remembering what happened after the dot-com boom. The MSCI World Index 3 years on was down 45%, and value was up. 5 years on, the MSCI World Index was still down in excess of 10%, and value was up something like 200%. So do we think value can continue? Well, we think when you look at the levels of dispersion in the market, we think that's very good news for value. And then when we reminisce of the last time they were at that level, like the dot-com boom, value could prove to be a very good diversifier for portfolios, just in case we do have another kind of bust like the dot-com bust. The second reason why we're optimistic about value is just the long-term track record. So, Juliet, let's imagine your two sets of grandparents in 1926. Both of them won the lottery on the same day. You got lucky genes. One of them decided to put they won 10,000 quid each. One of them decided to put 10,000 quid into growth shares. They were excited about all the new things that were happening then, cars and so on. And they would replace those shares every year with fast-growing companies. And the other one would put it into the value shares. They were kind of older school grandparents, comfortable with what they knew. Let's fast forward to today and see what those portfolios would be worth. So the growth grandparents, their portfolio would be worth a whopping $80 million today. The value grandparents, $780 million or pounds, an incredible long-term return. So the second reason why we think value will continue to do well is the long-term track record of value is outstanding. Continually buying shares that are cheap has delivered phenomenal long-term returns. Yes, it has difficult patches, and we're still within one even now after the recent bounce, but that just gives the opportunity today a very good time to be buying them. The bottom-up perspective, which frankly is more important, I think, is what are we seeing with our portfolio? And when we look at the portfolio today, we think it looks really attractive. Lots of companies with lots of upside and low risk. And the portfolio is more diversified today than it's probably ever been, the Global Recovery Fund. So we think it's got the potential to keep going. We think the top-down reasons, the level of dispersion, the long-term returns from value are there. And the bottom-up, when we look at the portfolio, we think that looks attractive too.
So, Simon, you have a high weighting to energy stocks. They've done very well this year. Are you taking some profits now, or do you think they've got further to go?
Short answer is we think they've got further to go. I think the energy stocks are in an incredibly interesting place because clearly they have a very substantial structural threat in the form of ESG. But remarkably, that's finally encouraged them to behave in a shareholder-friendly way. Finally, they are reducing capital expenditure and not going and digging holes in the ground all day long. Finally, they're reducing costs in the business. And finally, they are returning capital to shareholders. So the great irony is that actually what's happening now, we think from an ESG perspective, is good news for the world. And we think it's good news for shareholders because the companies are starting to behave in a shareholder-friendly way. Frankly, that's 20, 25 years overdue. But whilst they're showing capital discipline, hammering down on costs to boost the profits and returning capital to shareholders, we think that's a very attractive combination. And so we remain happy holders of the energy companies we've got.
You're also very overweight the UK, which has had an excellent start to the year. Is the UK still cheap, or are other markets looking better value now?
I think we would say the UK is still very cheap. The UK has had a torrid 5 years in terms of stock market performance and was the cheapest global developed stock market in the world. And yes, as you say correctly, Juliet, it's had a good the first 6 months of the year. But actually, we think the UK still has some very attractive shares within it. Banks, supermarkets, some energy companies, and a handful of others that we think remain extremely attractive shares. So within the UK, we still think there are many very attractive UK companies. But I'd also point out that there are lots of other companies that are cheap. So emerging markets, we think have got some very attractive companies in them. Continental Europe, we think, has also got some very attractive businesses available there for value investors. I'd also point to Japan. There is a lot of hidden value in Japan. When we go and look in Japan, we have to turn over a lot of rocks to go and find those kind of rubies in the rubble, as it were. But there are rubies in the rubble in Japan, companies that have very high reward, very good balance sheets, and critically, management teams that are returning capital to shareholders and behaving in a shareholder-friendly way. The corporate governance changes that the government are introducing in Japan are having an impact. And so, yes, we think the UK is cheap and there's some really attractive shares, but it's not just the UK that we think is cheap. Emerging markets, continental Europe, Japan, all of those regions are cheap. And I'd also point out to a region that no one ever talks about, which is global companies. We think there are a number of truly global businesses that are very attractive today. Some of the pharmaceutical companies where people worry about them having a patent cliff, but actually all pharmaceutical companies have patent cliffs every decade, and they all do the same thing. They go and spend billions and billions of dollars. They hire world-class scientists, and they normally change their management teams. And that combination of things typically leads to some new drugs being formed and the pharmaceutical companies being reconsidered by the stock market and typically going up a long way. So, we think there are a number of global pharmaceutical businesses that are out of favour today that we think will have their time in the sun and will be attractive. So, plenty of opportunity out there today, including but not limited to the UK.
And you have a tobacco company and some banks in your top 10, which I think people would expect. But what about Citizen Watch? What makes a watch company a value investment? What do you like about it?
Yeah, it's a great question. The thing about Citizen Watch is it is much more than a watch business. So I'll come on and talk about the watch business in a moment. But the first thing to know about Citizen Watch is they have a world-leading machine tool business, making automatic and robotic lathes for industry. They also have a world-leading precision measurement business, measuring very, very fine points between distances. They have an LED business, which does things like horticulture, lighting and heating greenhouses. Very important growth market for the world. And they also make switches, including the world's smallest switch, which is used, ironically, in smartwatches. So if you just look at those businesses, which we think include some very high quality businesses, they more or less cover the market cap of Citizen Watch today. Then the next thing that's worth knowing is Citizen Watch is a net cash balance sheet. It's got more cash than debt. And in addition to that, it's got 30 billion yen's worth of investments on the balance sheet. So, when you look at it, excluding the watches, it's not expensive. It's about reasonable value with no watches. It's got a good balance sheet. And then let's think about the watch business. So the watch business is, on most measures, the biggest watch company in the world. It sells watches in 130 countries around the world. It sells watches to kids' first watch for a fiver to billionaires' watches. It's got the whole suite of watches. And yes, we think the watch market's going to be smaller now and in 5 years' time than it was 10 or 20 years ago because of because of smartwatches, which I know you wear one of yourself. However, we still think there is a proper watch market out there, and that, yes, it will be smaller, but there will be plenty of people buying watches. And Citizen Watch are one of the best manufacturers of watches in the world. So, it's got this kind of great trade-off that there is a pretty low chance of losing money in Citizen Watch because of the kind of high-quality machine and industrial businesses I talked about, because of the balance sheet. We shouldn't be able to lose money. But there is a pretty reasonable chance, we think, of making a lot of money in Citizen Watch if the market ever reconsiders and relooks at the watch company. So Citizen Watch is a great example of what we do. It's called Citizen Watch, and everyone looks at the watch bit. But if you go and look elsewhere where other people aren't looking, in the depths of the annual report and the company presentations, you can find other parts of this business, the precision measuring part, the robotic lathes, that are actually really good, high quality and valuable businesses. And when you add the two together, we think low chance of losing money, good probability of making a lot of money. And that's the kind of thing we do. That's what we're looking across the whole portfolio for companies with a low chance of losing our clients' money and a high chance of making our clients lots of money. Those asymmetric opportunities. And we turn over hundreds and hundreds of rocks a year, and we find very, very few of these asymmetrically attractive companies. But what we end up with in the Global Recovery Fund is a portfolio of 50 companies broadly that we think are really attractive. It's the most diversified it's been, as I said, for a long time at the moment. And we think that's very attractive when you put that in the context of value over the long term delivers outstanding returns, and value today is at an extreme opportunity with dispersions at .com levels. So, we think Citizen Watch is a great example of the whole bigger picture and why we think the fund's attractive today.
That's all very interesting. Simon, thank you for chatting to me today.
Thank you, Juliet. Thanks for the chance.
For more information on Schroder Global Recovery, please go to fundcalibre.com.